Hi everyone, I'm Benny. Today, I'd like to show you about risk-adjusted return across financial asset classes such as precious metal like gold and silver, foreign exchange or FX, oil, US stocks, as well as cryptocurrencies. Here we'll be talking about what risk-adjusted return is, why you should care about risk-adjusted return, why risk-adjusted returns matter for your investment portfolio, and also how to calculate risk-adjusted return. If you like this video, please consider liking and subscribing for more videos like this, and don't forget to turn on the notification bell so that you get notified every time I post a new video. Alright, let's get started.
We are always exposed to risk whenever we are investing. Perhaps we are happy with the current return on our investment. However, we never know what the return will be in the future. Have you ever thought about a condition where our return on investment is commensurate with the risk involved? Consider two financial assets, let's say Apple stock and Bitcoin. As of 7 May of 2021, according to the data from Yahoo Finance, the expected monthly returns are 3.31% and 6.55% respectively. In this time period, Apple has a standard deviation of 7.42%. It is much lower compared to Bitcoin, which is at 20.2%. If we take the risk or the chance of losing some of the investment into account, then Bitcoin's risk-adjusted return would only be 0.32. This can be obtained by dividing the expected monthly return of 6.55% with its standard deviation at 20.2%. On the other hand, Apple's yield 0.45, which is higher during the same period. If we assume that both returns normally distributed, then using function normsdis in Excel, the probability of losing for Apple stock would be 32.78%, as compared to the probability of losing for Bitcoin is 37.29%. So, if we were to choose one of them, which one should we choose? Perhaps most of us will pick Apple instead of Bitcoin. The decision is most likely based on the calculation of risk-adjusted return, a concept that allows us to directly compare investments by incorporating the risk taken to produce their respective returns. Hence, it is important to estimate the risk involved in generating those returns. This is known as risk-adjusted return metric. If two investments have the same return over the same time period, then the one with the lower risk would have a better risk-adjusted return. There are 14 financial assets that we use in this analysis, namely Apple stock, Amazon stock, Binance Coin, Bitcoin against US dollar, Cardano, Dogecoin, Ether, Euro against US dollar, gold against US dollar, Litecoin, oil, Ripple, silver, as well as Tesla. This is the historical daily price of those financial assets from the 2nd of October 2017 until 7th of May 2021. The white horizontal lines right here represent the mean or average of the daily price. Next is daily returns. Daily return is simply the daily change of price level. For example, if the current price is 1,000, with 1,200 being tomorrow's price, the daily price return would be 1,200 subtracted by 1,000 and divided by 1000, it would then be equal to 20 percentage points. Another thing I would like to show is the historical monthly returns over time. Same as the previous slide, these horizontal lines represent the mean or average of the monthly price returns. Here is the price return indices. A price return index is an index that tracks the price return of a financial asset. It normally begins at 100. We see the dynamic of the price return indices from the beginning of this year up until 7th of May 2021. This chart shows the risk return profile, namely expected monthly return against its standard deviation or the risk. The next graph depicts the risk return profile changes over time. There are many ways to calculate risk-adjusted return. The most popular one is by using Sharpe ratio, which is calculated by taking an asset return and subtracting it with a risk-free rate, which is a return that you could get from investing in a virtually risk-free asset, such as treasury bill. Here we assume 0% in our example, and then dividing it by the standard deviation. The higher the Sharpe ratio, the better the risk-adjusted return will be. The Sharpe ratio has a drawback, that it treats both upside and downside volatility equally risky. However, most investors are more concerned with downside volatility than upside volatility. That's where the Sortino ratio comes in. The key idea for the Sortino is we need to specify a minimum acceptable return, also called the hurdle rate, instead of using risk-free rate for the Sharpe ratio. And in the denominator, instead of a plain old portfolio volatility, we use downside deviation. This is the chart that shows the historical level of Sharpe ratio over time. You can see that the highest risk-adjusted ratio for these financial assets change over time. But most of the time, the highest Sharpe ratio since the beginning of the year would be Dogecoin, which is getting more popular recently thanks to its growing list of influential celebrity endorsers who frequently voice their support for the cryptocurrency on social media. The most notable celebrity endorser of Dogecoin, however, is none other than Tesla CEO, as well as the world's on-off richest man, Elon Musk. Alright, that was a quick explanation about risk-adjusted return. If this video helped you, please give it a thumbs up to see more videos like this, and hit the subscribe button if you want to see me discuss any other topics, or simply leave a comment down below. That's all for today. I hope you enjoy and hope to see you next time. Bye.